I focus a lot on emerging markets, but the big economies, the U.S., the Eurozone, Japan, China, which I guess is an emerging market, set the tone to some extent, really drive the global economy. And, when we think about looking at countries, you always want to have, that kind of tucked into your mosaic. And so when I look at the global economy today, the thing that really kind of flashes in bright lights to me is the word uncertainty. So there's just like a lot of question marks out there in the world: global growth, inflation, the central bank policy and the Fed and the ECB, the BOJ. You have geopolitical conflicts that are flaring up to an extent that really hasn't been the norm, let's say, in the last, 15 years or so. You have war in Ukraine, unfortunately, as well, which adds to the mix of the great unknowns. And then there are the things out there that are going to pop up that might not even be on our radar right now. So I think of like the global backdrop is just one that's more uncertain today than in previous periods, and that's helping frame our thinking when we're investing in specific countries around the world.
So when we hear, most people hear these uncertainties, we tend to think of danger zone or blinking yellow lights. But uncertainty can also mean opportunities, right? Thank goodness for uncertainty. If everything is certain, I guess there is no opportunities left.
Yeah.
And we look to professionals like you and your team to really, tease out what are uncertainty that we really don't want to touch and what are uncertainty that maybe there are some things there. So I think investing in emerging and developing country bonds has always been sort of involved a couple of extra things called political and currency risks. And for our conversation, I'm going to just call these, developing and emerging as just emerging bond.
Sure.
But of course, emerging and developing countries are not a single and monolithic market, right? There are so many countries. There's a lot more countries in that basket than in the advanced economy or developed markets. I guess it's not unlike other, investment assets, stocks and bonds and other things. Long-term return commensurate with risks. So you talked about uncertainties, and you talked about, geopolitics and all those type of things. How do you think about EM bond opportunity today? Are there more opportunities or are there less opportunities, or how do you think about that right now?
Yeah. So, the opportunity set today is pretty rich. It's almost an evergreen statement. I could be pretty biased or accused of being biased. And when I say it's pretty rich, I don't mean that it's like cheap. Actually, I think at this point in time, there's been, a decent bid for a lot of emerging market assets. But the opportunity set is rich because there's a lot of things that are overvalued. There's things that are fairly valued, and there's things that are undervalued. And EM, the universe can be sliced and diced in different ways. And I think when you are, practicing investing in this space at its best, it's a very broad universe that usually has a number of things on offer. When you approach this asset class in the worst way, it sounds like the BRICS. 5 countries doesn't really represent this broad universe. It doesn't capture places like Afghanistan or Venezuela. I would say both are truly not on the investment map at the moment. But there's like 100 countries that you can invest in the EM space. And when you invest in these countries, as you pointed out, it's, there's a lot of factors at play, but political risk and analysis is an important piece of that. And so when you have that broad universe, there's always some countries that are doing the right things that are a bit overlooked. Assets are underpriced. And those are the like gems within the asset class. And then there's always things that are maybe captured the attention of investors to too large of an extent. Asset prices have moved too far too quickly. And the name of the game, I guess, is kind of avoiding those overvalued places and going to spots where just the risk premium is mispriced a bit, or in some cases mispriced a lot, actually. So